What's up everybody, GenExDividendInvestor here. So I was talking to my buddy Radsport AFC on Discord, and he suggested I start a new series called Ask GenX, where I answer questions asked by my subscribers and followers. So on my community tab on my YouTube channel, I posted a message saying that if you want to ask me anything, then follow me on Instagram at GenExDividendInvestor and send me your questions. So in this video, I'll answer a bunch of questions that subscribers post to me. Please don't forget to like this video. It's a simple way you can thank me for making it. And also consider subscribing to my channel and clicking the bell notification to be notified when I post more videos. Okay, let's tackle these questions. The first one comes from Strider Mag. Hi GenX, thank you again for all that you do. It really helps and inspires to continue going. I wanted to ask you, after all these years of hard work and investing, what would be your number one best advice? Thanks again for reviewing my portfolio. This is Max. Thanks Max, I appreciate the kind words. Max was the first subscriber portfolio I reviewed in a previous subscriber Tinder video. The best advice I have is simply to start investing. Don't overthink it. Pay off your bad debt, have an emergency fund, and then consistently invest in quality in up markets and in down, and don't sell. Do that and live pragmatically, and my guess is that you're going to do really well over the long run. The more you are planning to invest in single stocks, the more I would research things. Though another angle to consider is something like VU or other inexpensive broad market ETFs. I think ETFs are a smarter path for newer investors, actually for everyone. I just don't do it because I love investing in single stocks for a bunch of reasons. So do what I say, not what I do. LOL. Okay, the next one comes from Face Pulled to Docs. He said, Hi GenX, I'm a huge fan from Spain. Question, do you regret owning any company in your portfolio knowing that your ROI after 20 plus years could have been much greater if you had allocated your capital somewhere else? Thanks in advance. That's a great question. No, I don't regret owning any of my companies. I love investing in quality and I appreciate any returns I get. Sure, I've missed out on some great companies over the years, but I try to focus on and appreciate more what I have than what I don't have. Okay, the next question is from Jacoby Jones. He said, how does the dividend income work in terms of fluctuations? Essentially, do you receive the income at which you purchase the stock or the income at which the stock is worth at that point? So that's another great question because it is one that many people wonder about. In fact, my dad called me up the other day and asked me how badly my dividend cash flow had decreased because he had heard of the big stock market crash. And I had to explain to him that one of the things that I love about investing in quality dividend companies is my dividend income remains the same even when the stock prices crash. In fact, the crash started around February 12th, which is about 2 months ago, and since then my dividend income has actually increased because I've had 0 dividend suspensions and 0 dividend cuts and a ton of dividend increases since the crash started. From Travelers, Southern Company, Procter & Gamble, Johnson & Johnson, Realty Income, Colgate-Palmolive, Home Depot, Coke, and Pepsi. The more you invest in quality, the higher the likelihood that you will see increased cash flow in up markets and in down. Not ever a guarantee, especially during pandemic times like we're in, but so far so good. So think of that. My portfolio is down in overall value, but my dividend income has gone up. Let's do an example of how the income works to better answer Jacob's question. Let's say you buy 10 shares of J&J. Today each share costs about $150. So let's say you had $1,500 to invest and you got 10 shares of J&J. Let's see how much J&J pays out per share. So we go to Street Insider and put in J&J, and we see that Johnson & Johnson pays out $1.01 per quarter per share, which means it pays out $4.04 per share per year. Since you have 10 shares in our example, that means J&J will pay you $40.40 per year. Now let's pretend J&J falls down to $75 per share. That's the bad news. The good news is that you're still getting the same dividend income of $1.01 per share per quarter. So even though in our pretend example with J&J stock price falling in half, your dividend income remained the same at $40.40 per year. The same is true if we say J&J skyrockets up to $500 per share. You would still be getting the $40.40 income per year. The only way the dividend changes is if Johnson & Johnson's board of directors votes to suspend, cut, or hike their dividend. And we've seen that for over the last 50 years that they just increase it every year. Pretty snazzy. So to more specifically answer your question, your annual estimated income is whatever the number of shares you have multiplied by whatever each share pays out over the year, which isn't directly tied to the share price. How much the stock price is at is not directly tied to the dividend cash flow you are getting. Or to put in the terms you asked, your income starts at whatever it was when you purchased the stock, and then it changes based on what the board of directors votes and not what the stock price does. Okay, let's move on. The next questions come from Ken. Ken said, I enjoy your detailed videos. Keep it up. I'm not on Instagram, but I would enjoy more videos about the Dividend Kings. I would also like to see what you think about RTX. Do you plan on adding other positions to your portfolio? What interests you? You said before you made these videos for your kids to learn. Have you ever thought about making other financial education videos for younger audiences? Thanks for your questions, Ken. So regarding doing more deep analysis videos, I actually have a watch list of about 50 stocks, and I've identified my top 15 favorite ones, and you can bet there's some royalty in there. So maybe at some point in the future I'll do some deep analysis videos on my top favorite stocks on my watch list. Regarding RTX, let's go back one step and talk about UTX. I liked UTX and in fact used to own them. I sold out of them for a nice profit and to drive its proceeds into some other dividend stocks I wanted more. Now in terms of RTX, I think Raytheon is a strong defense company and they should continue to do well if the government continues to contract with them, which I'd guess they will do. In terms of adding more positions to my portfolio, I'm happy with what I have and would be okay to continue to keep growing them and nothing else. I am careful not to continually add new positions into my portfolio. When I was younger, I was more apt to add positions and sell positions, with a tendency to keep adding more over time. I have to fight to be complacent rather than constantly mucking with my portfolio, as that's my natural inclination. Isn't it ironic that it's harder to just let your portfolio work its own magic rather than constantly be meddling with it? Paul Samuelson, who was the first American to win the Nobel Prize in economics, once said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. I can't stress that enough. It isn't about buying and selling all the time. It's not about constantly adding to your portfolio. It is about researching, finding a good company, and growing with it as it grows. At least that's how I found success, and of course, there are many paths to wealth. Now, I want to share some other words of wisdom, and these come from the GOAT himself, Warren Buffett. He said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. I agree with that philosophy, which explains why I'm not constantly placing trades to make a quick buck. That doesn't mean it's bad to do that, it just means that it's not aligned to my long-term strategy for building wealth. Everyone needs to figure out what makes sense for themselves, and what makes sense to me shouldn't necessarily make sense for you. Like Buffett said, keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. He also said, the difference between successful people and really successful people is that really successful people say no to almost everything. Another quote from Buffett that I like is, all there is to investing is picking good stocks at good times and staying with them as long as they remain good companies. Remember that. So I tend to stick with what I believe in and know, rather than dilute my attention into others. One of the reasons I don't want to keep adding new positions to my portfolio is that I like to stay abreast of the companies I'm an owner in, at least to some degree, and it becomes challenging if I keep adding more companies. I look at each company that I'm an owner in and want to understand what it's up to, how it's doing, how it's evolving, what its competitive landscape is like, etc. If I weren't interested in following my companies, I'd probably just go with an ETF. Like Buffett said, if you like spending 6 to 8 hours per week working on investments, do it. If you don't, then dollar cost average into index funds. Great advice. So given I like to follow what my companies are doing, adding too many more positions becomes unrealistic from a time commitment perspective. I love my existing companies, so I'd need to factor in a variety of things before I'd add another. Like, do I want to move more aggressively into a new sector or industry? Or maybe there's a deal that looks way better than continuing to grow larger positions than what I already have. So to continue quoting Buffett, risk comes from not knowing what you're doing. Hopefully that helps explain why I like to do deep analysis before I invest. The sad part is that the more I learn, the more I realize I don't know. And then of course, I like to invest when I find the price compelling. Again quoting Buffett, whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. And I'll stress to not blindly follow me or invest in what I invest in. Don't get caught up in what I do. That doesn't mean you have to do the opposite, nor does it mean you have to invest in what everyone else invests in. I recommend you try to step back, remove your emotions out of it, research things on your own, and forge your own path. So right now there are a lot of things on my watch list which look compelling, but a lot of prices in companies I already own also look compelling. So I'm oriented to keep investing in what I have rather than keep adding new ones. I've learned that I always like to see growth in my companies and want to see a strong competitive advantage or moat in them. Watch my video on when to sell a stock to hear other reasons why I might get out of a position, which would then increase the likelihood of me going into a new one. That being said, I can see myself having a higher total number of positions in my dividend portfolio as I grow older. Okay, your next question was what interests me. Well, I love spending time with my family, and I'm passionate about video games, and I've had a blast building this YouTube channel as I like helping others learn and grow. Regarding making videos for younger audiences, I've thought about doing that and I started looking into it, and I found that Minority Mindset has actually done that and is partnering with teachers out there, and I love that channel, so I feel they'll release quality products. Okay, let's move on. The next question comes from Kevin, who is the channel creator over at Investing and the FIRE Movement Adventures in Us. Kevin produced some quality content, so check him out. He said, in your longer experience of investing, do you feel as though the markets are more volatile as the years go on, the same, or less? Also, since you've been through at least 3 crashes now, what are some tips you could give to someone going through it now that you got through those times? Well, I always feel like the markets are getting crazier, but the reality is that they've always been crazy. The dot-com crash was crazy. The 2008 financial crisis was crazy. This pandemic is crazy. The only constant is that it's pretty much always crazy. In terms of tips, what I've learned is to stay the course. Keep constantly investing in quality, in up markets and in down, and don't panic sell. In my experience, the people who panic sell and try to time when to get back in either end up not getting back in or usually time it wrong. You tend to only hear about the 1 in 10 that gets it right, not the 9 in 10 who get it wrong. So remember that when you hear someone talking about how they sold at the top and then rebought at the bottom. If they could consistently do that, they'd probably be a trillionaire, and we haven't seen that happen in the world yet. But we do have lots of people who only tell you about their successes in these markets and not their failures. Of course, when you lose, and you will, just learn from it. Dust yourself off and get back up on that horse. It sucks to lose a lot on paper, but if you keep moving forward, it should come back. I am pretty confident in saying that the US stock market will be in a much higher spot 20 or 30 years down the road from where it is today, which is why I invest in it. Okay, the next one is from Cohen J. And he asked, if you had to pick one of the following stocks to buy today, which one would it be? I need some exposure in pharma, and he listed Pfizer, J&J, and AbbVie. Since you don't have any exposure, I'd say J&J. Now that's tough because it has had a big run up even in this market. But J&J is one of those that I kind of see like a savings account. I feel like if your holding time frame is decades, then it's hard to bet against them. Would I rather it was down? Yeah, it sucks buying at all-time highs. But if you don't own any pharma, then J&J is probably worth looking at. I also think taking a position in Pfizer makes some sense, so I might do a hybrid. AbbVie is a longer shot, so it depends on your risk tolerance. Okay, the next question comes from another channel creator, Malone Money Mindset. Malone is a great guy who is passionate about sports, especially football, as well as investing. Check him out. He said, I just saw your post on the community tab. I'm not sure if you've already covered this in one of your videos. I'm curious, when you first started your portfolio, did you implement a DCA or lump sum strategy? And what was either the amount of your first lump sum investment or weekly, monthly DCA contribution? So when I started investing, I had very little money and I just started DCAing. Over time, I moved to more of a strategy of saving up cash and then waiting to dump it when the prices look good. And then I let my drip DCA. So kind of a hybrid strategy. My first contributions were low. I was making about $30,000 a year at my first job. So I think I was contributing like $50 a week. I spent way too much money on cars and vacations and girls. Do I wish I had invested more? Yes. Do I love all the experience I had even though I spent more than I probably should? Yes. It's good to be balanced in life. Don't overinvest, don't overindulge. Okay, the next question comes from a new channel creator named Money is Freedom. He said, hello my friend, just created this account for the question for your video. I would ask, what kind of dreams in life will your dividend payouts help you achieve? So my dream is to create a platform which gives my kids and their kids and their kids a more secure future and leg up. I never had any financial help like that as an adult, and so being able to help my future generations excites me. I also enjoy being able to donate to charities such as St. Jude's, and I love traveling, so more financial security helps enable those various goals. Okay, the next question comes from Dumida1, and he said, hi, Daniel D here. Regarding the question video, what will it take for you to add a new company for your dividend portfolio? And by the way, you said that you also have a growth portfolio. When will you review it? Last question, you said at one point you sold all of your companies. When will this video and story go up? Thanks and stay healthy. Thanks, Daniel. I reviewed Daniel's portfolio in a previous subscriber Tinder video, in case you're interested in hearing my thoughts on it. I already answered a question about what it would take for me to add a new company to my dividend portfolio. In terms of my growth portfolio, I'm not sure when I'll review it. My channel has been focused on dividend investing, so I'm not sure I want to dilute that focus. I'll think about it though. Okay, now your last question. When will I put up a video about the story of why I sold out of all my positions once? It's another good question. I'll do this at some point, but I don't know quite when yet. When I'm ready to do a new video, I look at my backlog of ideas and pick one that I think makes sense based on what will bring the most value or what I'm interested in doing, or etc. I also factor in what people are asking for, so I appreciate hearing your input and thus influence. Okay, next up is Fox Racer 134. Hey there, I just found your YouTube page recently and I found it really informative and helpful. Since you are super geared to having dividend wealth into your retirement years, I would have to assume that one's portfolio would exceed over $500K in investments in order to do so. Does it make sense to open up another account at a different brokerage provider to cover yourself insurance-wise in case one brokerage goes under? SIPC covers up to $500K. Or do you recommend keeping it all in the same brokerage no matter your portfolio dollar value? Thanks in advance. Stay safe, Dennis. Thanks, Dennis. So that's a great question. So let me explain some context first. The Securities Investor Protection Corporation, or SIPC, is a federally mandated nonprofit U.S. corporation created under the Securities Investor Protection Act of 1970 that mandates membership of most U.S. registered broker-dealers. It's meant to protect customers if a brokerage firm fails. If a brokerage goes under for some reason, the SIPC protects securities and cash in your brokerage account up to $500,000. The $500,000 protection includes up to $250,000 protection for cash in your account to buy securities. Brokerage firm failures are rare. Without SIPC, investors at financially troubled brokerage firms might lose their securities or money forever. Although not every investor or transaction is protected by the SIPC, no fewer than 99% of persons who are eligible get their investments back with the help of SIPC. From its creation by Congress in 1970 through December of 2018, the SIPC advanced $2.9 billion in order to make possible the recovery of about $140 billion in assets for an estimated 773,000 investors. When the Bernie Madoff Ponzi scheme issue came out, the SIPC stepped in to protect its customers. My understanding was they paid out about 63% of the claims, which was around $11.43 billion. An example of a firm failing was Lehman Brothers, which was one of the largest bankruptcies in U.S. history. My understanding was that the SIPC stepped in to help out a ton of impacted customers. So Dennis's question is, does it make sense to have your investments split across multiple brokerage firms if you have more than $500,000 in assets? The quick answer for me is no. When my accounts passed $500,000, I actually called up E-Trade because I was thinking I would need to start moving additional cash and investments into a new brokerage. What I found out was that E-Trade buys extra insurance, I believe they said from Lloyd's of London, to insure their customers for significantly more than SIPC insurance. They do this so that customers continue to have larger and larger portfolios with them. They also said for really big whales, they'll get individual insurance to ensure they are covered. Now, you might feel better to split your money between brokerages as a risk mitigation strategy, but I'm comfortable enough that I primarily use E-Trade, and then I have smaller investments in other places, like M1. But each person should weigh the ease of having all your investments in one place versus the potential risk mitigation they think they might get. I also recommend that as your investments get bigger, you utilize all the various security measures that your brokerages offer. For example, E-Trade has a rotating pin which changes every 60 seconds as an app on your smartphone that ties to your specific brokerage account, which then you concatenate onto your password when you log in. So it's significantly more challenging for a hacker to break into your account. Nothing is foolproof, of course. Okay, I want to close this video with a thanks to everyone who's been with me on this YouTube journey. When I started my channel, I had planned a fun puzzle contest thing, and part of that contest had a hidden video which was found by spelling out the letters of a URL I slowly revealed over multiple videos. Part of the clues I gave out was when I instituted adding the word #partner and a number in each of my comments, which signified how many of my videos someone had watched and commented on. It also helped me identify subscribers who were really engaged, so I could acknowledge them on my scrolling news ticker in my videos. Well, I now have another method I track who's commenting on my videos, so with this 50th video, I'm going to stop my little #partner game. Thanks for everyone who participated. Finally, if you'd like to ask me a question and be highlighted in my next Ask GenX video, then follow me on Instagram and DM me your question. Thanks, and I'll leave you with this quote from Marilyn Monroe. "Imperfection is beauty, madness is genius, and it's better to be absolutely ridiculous than absolutely boring." Thanks, and I'll talk to you in my next video. Remember, I'm not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I'm only sharing my opinion with no guarantee of gains or losses on investments. Don't use this information without double checking it and talking to someone a lot smarter than me after you completely understand it. So I'll see you in the next video, and remember to stay positive, patient, play for the long term, keep investing in great companies, budget reasonably, and win. I know you can do it. Just like I know you can hit the subscribe, like, and bell icons, share this video with others, and comment below.